Good afternoon, ladies and gentlemen. It's a pleasure to be here to speak to you today. The last time I spoke at one of these events was actually the day of as an England football match in the World Cup, but we still had a full audience, and today it's even better. We've got a standing room only. I was a bit worried because there was supposed to be a very important vote in the House of Commons today, but thankfully the Prime Minister has decided to defer it, so I'm glad you're all here today to watch this, which is great. I've labelled this speech Home Advantage, Finding Income and Value in UK Equities, because I'm conscious that the UK is really out of favour at the moment with overseas investors and global investors, partly because of Brexit, maybe mainly because of Brexit. We're seeing a lot of money coming out of the UK market. We've seen £26 billion of money taken out of UK assets, UK invested assets, active assets, in the first 9 months of this year, offset slightly by £9 billion coming into passive. But in general, we've seen a lot of money coming out of the UK. So why have I said Home Advantage, Finding Income and Value in UK Equities? I'm going to start with a few charts on why I think there's such an interesting opportunity at the moment, and then talk a bit more about the Merchants Trust, which is the fund that I run. So, right. Well, the first thing to say about the UK, and probably the most important thing I'm going to say all day in terms of things to remember, is the UK stock market is not the UK economy. About 2/3 of our profits and revenues from companies comes from abroad. And if you think about the history of the UK, it's been a trading nation and a naval nation for centuries, really. And even the Merchants Trust, the trust I manage, was set up 130 years ago to invest in railroad bonds in America when that country was industrializing and elsewhere around the world. And so the UK's always had a very dynamic global outlook. And when you look at the composition of the UK stock market, you see that reflected in the businesses. So, for example, oil and gas and basic materials, which is mining, they account for about 22% of the value of the UK stock market. And those companies predominantly drill oil and mine materials all over the world, but they're selling in dollar-based commodities in prices set on world markets. They're not in any way significantly affected by what's happening in the UK economy at all, and therefore Brexit is not really going to affect these companies. Similarly, consumer goods, Job just talked about companies like Unilever and Diageo, which are global businesses, many industrials, and healthcare companies, again, very global. America tends to be a big market for those, as well as the rest of Europe and Asia. So when you look across the market, we think about 60% of the stock market is in genuinely international or multinational companies, and about a quarter of the market is mostly domestic businesses, and there's a few hybrids in the middle. Some of the financial stocks, some of the other companies are hard to classify. But if you go through the whole market, you end up with about 2/3 coming from outside the UK. So for that reason, the direct effect of Brexit on the UK stock market is not going to be that significant, or not as significant as you might think. And also, when sterling devalues, if sterling devalues, which it has done so far because of the concerns of Brexit, that can actually give a boost to a UK investor from their cash flows coming from overseas. And many of the big companies in the market pay dividends in dollars or other currencies. And therefore, if sterling weakens on the back of Brexit and concerns, that can actually help UK investors. So the first thing I would say is the UK market is not the UK economy is not the UK market, and there are lots of opportunities from overseas investments. The second thing, and Job touched on this as well, is the valuation of the UK market is really quite interesting. What we show here is something called the cyclically adjusted PE. Essentially, you're taking the last 10 years of profits for companies and saying, how much am I paying on average for the last 10 years? And the reason you do that is because companies can be very cyclical. Some companies are steady, but some are very cyclical. And in order to adjust for that, you say, if you look at the average profits they've made over the last 10 years, how much am I paying for those profits? And you see the UK down there is about 14 times. So you're paying about £14 for every profit the company has made on average in the last 10 years. That's below the very long-term US history. But more importantly, it's below other markets, other major markets, such as the US, such as the big European markets. And it's a pretty attractive valuation compared to history. So as well as benefiting from having very high international earnings, the UK stock market benefits from a very low valuation, and only places like Italy, Spain, Russia and Greece are trading on lower valuations than the UK. So that's quite interesting as well. And the third slide I've got, again, it's on valuation, but different way of looking at things. The chart on the right-hand side compares the UK valuation to the global, the world, MSCI, Morgan Stanley World Index. And we are trading at about a 30-year low in terms of the relative valuation of the UK compared to the rest of the world. So you've had to go back almost 30 years to about 1992 to see, or 1990, 92, to see valuations of the UK at a similar discount to the rest of the world as you're getting today. That, to me, is a sign that there might be quite a bit of value in the UK. And the final chart on the right, on the left-hand side here, is how many companies in the UK have a dividend yield of 5%. Well, it's almost a third of the market has a dividend yield of over 5%. And again, it's yet another sign that there are lots of interesting opportunities for a patient value investor to take advantage of if you look in the UK market. So we are finding really interesting opportunities today. I'm now going to say more about the Merchants Trust. And the Merchants Trust, a bit like City of London, has been around a very long time. It's fully invested in the UK stock market, so slightly different from the trust that Joe was describing. We only have UK companies, but as I said earlier, the UK is very global. We have a very high dividend yield, 5.3%, one of the highest yields in the sector and significantly above the market average. And we have had a very high yield for a long time. And we've also grown the dividend every year for 36 years. So we, like City of London, Merchants Trust has a long-term record of growing its dividend. We have a strong performance record, and we are active value investors. And by active, I mean we do move the portfolio around quite a lot, and I'll show you some of the moves we've made this year, because we do move to react to where the value is. But also we are value-driven, and again, I'll show you that. We do like to buy companies we think are cheap, and historically cheap companies give you better returns, even though they can be a bit more volatile individually. And we have high conviction portfolio. Again, we take pretty big positions in the portfolio where we have conviction. We have a very modest management fee, 35 basis points on 0.35% on the gross asset value. And we have an experienced board of directors which comprises both investment specialists, people who've worked in investment management industry, with people working in the commercial world, such as in real estate or in media industry. And that gives us that gives hopefully shareholders some comfort that there are people there whose only job is to look after the shareholders in the trust, where they're holding us to account, but they're also advising us as managers on areas that they think are interesting and using, that they've seen in other cycles or in other contexts before. If I talk about the investment philosophy of Merchants, this is probably a crucial slide to understand what we're doing. We make no apologies that we like buying high-yielding companies. And what's really interesting is if you go back, if you put a £1 in the stock market in 1900, and you invest, if you live to be 111 years old, by 2010, your £1 would have grown to £20,000 if you'd reinvested your dividends every year. If at the beginning of each year, rather than buying the top 100 companies, you bought the 50 companies with the highest dividend yield, and then the next year you sold those and bought the highest companies with the highest dividend yield at the beginning of the following year, and so on, your £1 would have grown to £93,000. So you could have outperformed the market by 1.5% per annum over 111 years and made a very considerably higher return by buying the highest yielding shares every year. That's one way that value investing works. Buying shares that are out of value with a high yield tends to give you a better return. Now, clearly, we don't buy every company with a high dividend yield. Many of the companies with high dividend yields have big problems, and those dividends might not be safe and secure, and the companies might have issues. But we think it's a very fertile place to invest. We think it's a good pond to fish in, if you like. So we target companies with a yield in line with the market or above today or within the next 18 months. But we never buy a company because of the dividend yield. We only buy a company where we think we make a good total return. And equally, so the total return drives the decision. And we don't automatically sell a share when the yield drops below the market. And one or two companies do cut their dividends, and often that can be a way the company deals with a particular problem and can do very well afterwards. So we don't automatically sell a share if a company cuts the dividend or if the share price goes up and the dividend drops below the market. But essentially, we are looking for high-yield value investments. What do we look for in a company? We look for three things. We ask three questions, really. The first, the fundamentals. How good a business is this? How attractive is the industry? How strong is their competitive position? What sort of products do they have? Services, technologies? How strong is the financial position, the cash flow, the balance sheet? Who are the management team? What's their track record? How are they incentivized? What's the governance arrangement around that? How are environmental, social and governance factors brought in and to the equation? And we spend a lot of time trying to understand that. How good a business? The second question, how cheap is the business? How does the valuation today compare to the valuation over history, compared to other companies we can buy in the sector, and more broadly to companies we can buy across the whole market? We're looking for relative value. And the third question, and probably most subtle, is, okay, we've got a company we like, it's cheaply valued, but what's going to change? Thematically, themes are incredibly powerful. If you can find companies that can benefit, say, from demographic trends around the world or from the opening up of emerging markets, that can be really powerful. Equally, if you're a company that's being damaged by the internet, that can be very damaging. So we need to understand the long-term structural themes that are affecting businesses, but also the cycles. Where are we in the business cycle? Where are we in that industry cycle? And we try and put that together to find a fundamentally sound business with an attractive valuation and a supportive macroeconomic or thematic environment. We will sell a share if it achieves our target price, and we're quite rigorous about investigating companies when they move in price, if the investment case changes, or if we find better opportunities elsewhere. So to give you one example of that, a year ago we had no tobacco in the portfolio. We were nervous about the new products coming in and the challenges to tobacco companies, and we thought the valuation of tobacco companies had got too high, so we had no tobacco. But actually, earlier this year, we bought Imperial Brands, which we haven't owned for 5 years in the Merchants Trust. Now, as a business, it's fairly straightforward. It's one of the largest tobacco companies in the world. Tobacco is a product with significant pricing power. It's obviously highly addictive. There are big barriers to entry. It's really hard to establish a tobacco company today, and very cash generative. Businesses have a long-term track record of generating lots of cash, becoming more efficient, and pushing up profit margins. They've also got some new products in e-cigarettes in particular, which are relatively attractive. So fundamentally, it's a sound business, or it has been historically. The valuation, having been unattractive for much of the last few years in our view, suddenly got really attractive this year. This is the dividend yield on Imperial Brands. It's gone from 4% 2 years ago to around 7 or 8% today. And when we were buying it earlier in the year, it was at 7.5% dividend yield. So you're getting paid as an investor 7.5% income on day one for buying these shares. And we think that dividend can still grow in the future. So that valuation is really unusual for Imperial Brands. But the question, of course, is what's going to challenge? Why is it there? Why have the shares been so weak? And this is the big one. The structural concerns about what's happening to tobacco. Fewer people are smoking. They push prices up quite a long way. And there are new disruptive technologies, e-cigarettes and heat-not-burn, other types of cigarettes. So we're not blind to these issues, but we do now think they are priced in. And we actually think Imperial specifically has some recovery potential in the business because they were losing market share. They seem to have turned that around for various reasons, which I can go into another time. We think they do have some new products which can benefit in the e-cigarette area. And I think they still have strategic value in a consolidating industry. So for all those reasons, we've overcome the concerns we had about the structural pressures to think there's a positive investment case here. If I look more broadly, when I said earlier we are active investors, we have been pretty active this year. We've added about 5 new companies in dark green to the portfolio in a number of different sectors, but where we've seen value. We've sold 5 different companies. So Joe was talking earlier about Diageo. We've actually sold Diageo this year, having owned it for many, many years. We find the valuation isn't attractive enough for us anymore, and we find plenty better opportunities elsewhere. But also we've been reducing the big oil companies, which have performed very, very well, and we think they're still good companies, but we've taken some money out. So we are active investors, and we will rotate the portfolio to where we see the best value at any time. If I talk about a couple of themes, I'm not going to spend long on this page, but there are some themes in the portfolio we try to exploit. For example, if we can find exposure to emerging markets where we think the consumer spending and consumer growth will be a long-term trend. We've got companies like Prudential, which is selling insurance in Indonesia and Hong Kong. We've got companies like Informa, which have a massive exhibitions business in China and Hong Kong. So we think those businesses have structural growth drivers behind them or backing them up, which is really helpful. If we can find companies that benefit from the digitalization of the economy, such as IG Group or GVC, which is growing very fast in the online gaming industry, If you can buy those at a sensible price, I think that's a really interesting opportunity. Many of the real winners in the digital area are very highly rated, and so we wouldn't necessarily buy them in this type of portfolio. But where we can buy them at a sensible price, we think that's attractive. So there's some of the themes in there, and you'll see some similar names to the ones that Joe was mentioning earlier. But we are also quite different to many trusts in the sector. So, for example, we have nothing in the beverage sector. We have very little in the personal goods and the consumer staples area. So if you look at many of the companies Joe was talking about earlier, like Unilever, Relex, Diageo, we used to own those types of companies a while ago. But because of our strict valuation discipline, we've now sold many of those companies, and we're investing in other areas where we see better value. One such area, for example, is aerospace and defence. We see a recovery in defence markets around the world. Defence spending, having been cut back for 4 or 5 years, is now growing again, particularly in America, which is the key market. And we're finding interesting companies we can buy in aerospace and defence, which also have that backing behind them. So that's an interesting, attractive area for us. If we don't have a positive view on a company, we won't own it at all. So we don't own BAT, AstraZeneca, Diageo, Unilever. We're not necessarily negative on those businesses. We just don't have a positive view. And if we do like a company, we try and have a big position in it, such as GlaxoSmithKline or Standard Life Aberdeen. Just a couple of words on the investment trust and our dividend record. Merchants Trust has raised the dividend every year for 36 years. A bit like the City of London Trust, it's a very high priority of the board of directors to pay a high and rising dividend. What we've shown on this chart is the dividend every single year, but we've also shown in the green bars where the directors put money away into reserves, where the earnings were above the dividend and the directors put money away, such as going into the financial crisis in 07, 08. And then the directors were able to draw on those reserves in 2009, 2010 to continue growing the dividend every year. Where we are now is we're now once again covering the dividend, and in fact the income growth has accelerated. We have, a bit like City of London's taken out some long-term debt, we have refinanced some quite expensive debt earlier this year with some very cheap long-term debt, which has given a boost to the earnings as well as we go forward. So just finally from me, in terms of the long-term performance of the trust, of the net asset value is significantly above the benchmark over the last decade. And yeah, just to finish, to restate what I said earlier, we have one of the highest yields in the sector. A high and growing dividend is an absolute priority for Merchants Trust. We have a strong performance record driven by this active, value-driven approach. And by active, I mean not just we take big positions, but we do move the portfolio around where we see opportunities. And we have a low management fee and a very experienced board of directors. With that, I'll hand you back. Thank you very much.